Let's talk about required minimum distributions, RMDs. The IRS, which the Internal Revenue Code that was written by Congress, it requires us to start taking distributions out of our retirement accounts, typically in the year we turn 73 years old. And the reason for that is we have to realize we have a lot of tax incentives to save in our retirement accounts. So these are our IRAs, our 401ks, our 403bs, 457s. It's a whole alphabet soup. It's everything except for Roth. You never have an RMD from your Roth in your name. So it's everything else. But when we contribute money to those accounts, we typically get a tax deduction when we do that. So think about when you add money to your 401k, it's coming off your taxable income, so your contribution was not taxed, typically. And then the employer contribution was not taxed. And then as the accounts are growing, they're growing tax deferred. It's deferring the tax to a later date, so the tax hasn't been paid on the earnings growth. So you haven't paid any of the tax on most, if not all, of that account balance. So at some point, you've got to pay the piper. It's like having an IOU to the IRS. And so that IOU comes due in the year you turn 73. And the way they do the math on that is, if I was turning 73 this year, it doesn't matter when during the year I turn 73, it's the year I turn 73. So I could take the distribution anytime from January 2nd to December 31st. So they're going to go back to the end of last year and look at the balance on December 31st of last year. So let's say my balance was $500,000 in my IRA or 401k. And they're going to divide by a number in what is called the Uniform Lifetime Table. It is in the Internal Revenue Code. And if I look at the divisor for a 73-year-old, the divisor is 26.5. So think about it, that's like 1/26th. It's just a little less than 4%. 1/25th would be 4%. So it's just a little less than 4%. And if I do the math on that, it's just shy of $19,000 that I have to take out of my retirement account, and it'll be reported on my tax return as taxable income. So that's how they do the math on that. Now, the one exception to the Uniform Lifetime Table is if you have a spouse that is more than 10 years younger than you are, and your spouse is 100% the primary beneficiary, you use a different table. And basically it means, it's called a joint and life survivor table, and it basically means you don't have to take quite as much out. You know, you can always take more. So we want the minimum to be as low as possible because it is a forced taxable distribution. Okay. Now the first year, the year we turn 73, we actually can put that first RMD off to the following year. And we'd have to, if I did that this year, that means I'd have to take this year's RMD by April 1st of next year, not April 15th, April 1st. But let's say I do that and I put this year's off to next year. But then next year I still have to take next year's too. So see, I'm going to have to take 2 in that year. So as a rule of thumb, most people, the year that they turn 73, want to start looking at going ahead and probably taking their RMD. The biggest exception to that is if you are very confident or know that your taxable income is going to drop pretty substantially the following year. So if I was retiring this year and I turned 73 this year, I may say, well, I'm going to have a lot less taxable income next year. So I'd rather put that $18,000, $19,000 distribution into next year. So that's how those RMD rules work. And then every year we have to recalculate it. And again, it's based on the balance at the end of the prior year. The other thing I really want to stress is every retirement account, based on its tax structure, has its own rules. So here's what that means. Let's say I have 3 IRAs. Instead of one IRA at $500,000, what if I have a $300,000 IRA, $125,000 IRA, and a $75,000 IRA. I add them all together, it's $500,000. The IRS in that case, if they're all IRAs, they don't care where I get the $18,000, $19,000, the minimum distribution. I could take it all from the smallest one if I wanted. So I have a better planning tool to use there in terms of how I handle my investments and my distributions, because I can be smart about which account I take that RMD from. But I cannot use that. I call it the aggregate rule. I can aggregate those accounts together. You cannot do that on different types of retirement accounts. So in other words, I cannot aggregate an IRA and a 401k. They each have their minimum. If I take more out of the IRA thinking I've satisfied the 401k, it's tough luck. I'll have a penalty because I didn't take the RMD from the 401k. The only other types of like-type retirement accounts you can aggregate like that are 403Bs. So if you have two 403Bs, you can aggregate them. But if you have a 403B and an IRA, you cannot aggregate them. The minimum has to come out of each one. So it's critically important to understand these rules and not trip yourself up unnecessarily, and know what is the actual tax structure on the account. I can't tell you how many times I have people come into my office and they'll say, hey Jim, here's my 401k. But it's actually not a 401k. It was a 401k and they rolled it into an IRA. Or they say, Jim, here's my 401k and it's actually a 401A. Well, they all have their own little nuances. So understanding RMDs is a critical thing as you age.